All right, let's look at this example. Darci Company is a retailer of toeless socks, right? They use those for like yoga, Pilates, things like that. On April 1st, the company sells $5,000 of merchandise that has a cost of $2,800. The sales tax rate is 9%. Record the journal entry. Okay, so April 1st. We know our journal entry has to have date, accounts. We'll skip posting reference and go right to debits, credits. Let's assume cash. They don't tell us otherwise, so we'll assume it's a cash sale that happened. There's the merchandise. Okay, so sales revenue, which is a credit. 5,000, leave cash for last because it's going to be the sum of the two. Okay, we collect sales tax, which we said is a liability for Darci Company. It is 9% of the sales price. Okay, $450 is the amount of cash we collect on April 1st. Oops, 5,450. Record sale of goods subject to sales tax, something like that. Now, a lot of my students, they stop here. They say, oh, they were just giving you this $2,800 to throw you off. No, they're not. Remember in chapter 6, we learned if you sell to do that second journal entry, inventory is recorded at cost. So 2,800 is the other journal entry you will make on April 1st to record cost of inventory sold. Let's say that we have to remit all sales tax at the end of the month. Okay, let's look at that journal entry to record remittance of sales tax. Okay, just like when you pay off any liability, debit the liability, sales tax payable for the $450. And your offset is cash because you took in more cash than the sales price. And the reason was because of that sales tax payable, which you have to remit. So it's going to come out of your cash. There you go. Okay, so you know how to calculate sales tax, you know when it occurs, and the journal entry to record, both recording it and remitting it. Great work.